Yes, I have opened chapter number 4. Now, chapter number 4, it deals with risk assessment and internal control. Two aspects will be dealt. Basically, if you see, till now we have discussed SA 200, SA 210, and we have also discussed SA 300, right? These standards we have discussed till planning stage. Now we will be moving into the next stage, which is part of execution stage. So here in this chapter we will be covering five standards. So the standards that we will be covering here are, firstly, SA 315. Now if you remember, I told you that the audit that the auditor conducts is a risk based audit. In the risk based audit, what will happen? Auditor will first of all identify the risk by performing a RAP, risk assessment procedures. These risk assessment procedures will be discussed in this SA 315. Risk means what? Risk means the term risk you will use to specify something negative, right? So in case of audit, risk means the risk of occurring misstatement, right? So let me tell you the linking between the standards that we are covering. Okay, so here now I will be telling you the linking, how each of the standard is linked with the other standard. So as per SA 315, you have identified the risk, not actual misstatement you have identified. Okay, you have not identified actual misstatement, you have just identified the risk. Now once you have identified the risk, by seeing this risk, will you be just silent? No, you will design procedures, you will design further audit procedure to respond to this risk, correct or not? So the next stage is that only, respond to the risk. How you will respond? By performing further audit procedures, which we will discuss in SA 330. So 315 is covered here, 330 is covered here. Now by performing these further audit procedures, you will identify actual misstatement. Once you have identified the actual misstatement, you will evaluate that misstatement, correct or not? So is this misstatement small, is this misstatement big, will this misstatement have impact on the entire financial statements, or is this isolated? Like this you will evaluate that misstatement, correct or not? So evaluate the misstatement. So evaluation of misstatement will be dealt by SA 450. Understanding? So did you understood how 315, 330 and 450 are interrelated to each other? Now there is also SA 320. Now you have identified this misstatement in SA 330 by performing further audit procedure. You always remember that auditor is concerned only with the material misstatements. He is not concerned with the immaterial misstatements. Now how to identify which misstatement is material, which misstatement is immaterial? SA 320 deals with materiality. Understanding? So even SA 320 is also related to this SA 315, 330 and 450. Understanding? Now as part of this SA 315, apart from assessing the risk, we will also be verifying internal controls. Now in this internal controls, if you find any deficiency in the internal control, you will communicate that deficiency to those charged with governance and management. Do you know what is difference between those charged with governance and management? We will also be discussing that. Okay, so internal controls deficiencies you will communicate to those charged with governance and management, which will be dealt by SA 265. Understanding? So this way we will be discussing 315, 330, 450, 320, 265. All the five standards which are linked to each other will be covered in the single chapter. Clear? Yes. So I gave you the brief idea of the chapter that we are going to cover and how each of these standard is linked to each other. Now starting with the chapter. So just now I told you the standards covered here are SA 315, which is identifying and assessing the risk of material misstatement through understanding the entity and its environment, right? Next, SA 320, which deals with materiality. Next, SA 330, auditor's responses. SA 450, evaluation of the misstatements, and SA 265. So these are the standards that we will be covering. Let us start with the first standard, SA 315. Now, what is the name of SA 315? See, by seeing the name of SA 315 itself, you can get to know a lot of things. See, what it says, identifying and assessing ROMM. ROMM means risk of material misstatement. So you will be able to identify and assess the risk. How you will be able to identify and assess the risk? By understanding the entity and its environment. Okay, so if you properly observe, if you properly understand the entity and its environment, you will get to know what are all the risks that are there in the entity. Understanding, see, not only the entity, whatever the area you are going to audit. Let's say you are going to audit sales. Will you directly audit the sales? No. First of all, you will understand what risks are there in the sales. How you will understand what risks are there in the sales? By understanding the item of sales, you will get to know risks involved in the sales. Getting it? So the risk assessment of any item you can perform through understanding that item. Getting it? Yes. So that is the name of the standard and the content that we are going to discuss. So before starting the standard, let us understand a particular term, which is assertion. So what is meant by the what is meaning of the term assertion? So assertions are representations made by management to the auditor. So how management will make the representations? Let me tell you. Management, they will prepare the financial statements. So financial statements means balance sheet, P&L. So in the balance sheet, management shown assets value 2 crore rupees and given to the auditor. That means management is asserting to the auditor, see auditor, the entity is having assets worth 2 crore rupees. This is nothing but a assertion. So assertion means telling to the auditor that something is true, is known as assertion. So if in the balance sheet entity shown liability is worth 5 crore, means what? It means that entity is having obligation to pay that liability. So entity is saying the auditor, see auditor, we are having obligation to pay 5 crore rupees. That 5 crore rupees is correct only. Like that you are asserting to the auditor. Now auditor duty becomes to verify whether that assertion made by the management is correct or wrong. That is nothing but the audit that the auditor will do. Getting it? Yes. So understanding the term assertion. Assertions are the representations by management, either explicit or otherwise, that are embodied in the financial statements. Where these assertions will be present? In the financial statements will be present. Understanding? Now these assertions, you can classify them into three categories. Assertions with respect to class of transactions. Where the class of transactions will be there? In the profit and loss statement. Correct or not? So other assertions with respect to class of transactions, assertions with respect to account balances means balance sheet, and assertions with respect to presentation and disclosure. So into these three categories you can categorize the assertion. Now each category is further having certain assertions. Let us see. So assertions with respect to class of transaction. Class of transaction means you should always remember P&L items. So with respect to P&L items, that is sales, purchases, expenditure, what assertions you will have? Occurrence assertion. So sales have actually occurred. Like this you are asserting to the auditor by showing sales in the profit and loss statement. Next, completeness. Whatever the sales that we have shown in the P&L, that are complete. We haven't missed any sales from entering into the P&L. Like that, the management will assert to the auditor. Next, accuracy assertion. Accuracy assertion means during the year 1 crore worth of sales has taken place and we have shown 1 crore rupees in the P&L. That is accurately we have shown the amount in the P&L. This is accuracy assertion. Next, cut off assertion. Cut off means, see, you will prepare the financial statements for one particular year, correct? So the transactions that have occurred in the current year should be shown in the current year financial statements. Transactions which are related to the previous year, you should not show in the current year, and transactions that are related to next year should not be shown in the current year. That is nothing but cut off assertion. So you are asserting to the auditor, only transactions that occur during the current year we have shown in the P&L statement. Getting it? Yes. Next, assertion related to classification. Classification means revenue items should be shown in the P&L, capital items should be shown in the balance sheet. This is the classification of the items, correct or not? So you are asserting the auditor, we have properly classified these transactions into revenue and capital. Getting it? So in the P&L statement, by giving a P&L statement to the auditor, management is making all these five assertions. Similarly, while giving a balance sheet also, management will make these assertions. Existence assertion. So in the balance sheet, assets will be there. So you are telling to the auditor, whatever the assets that we have shown in the balance sheet that are actually present, that are actually in existence. Clear? Yes. Next, rights and obligation assertion. Rights and obligation assertion means the auditor, whatever the assets we have shown in the balance sheet, entity is having right over that asset. Whatever the liabilities we have shown in the balance sheet, entity is having obligation to pay off those liabilities. Like that you are making the assertion. Next, completeness assertion. Completeness assertion means, see, in the balance sheet we have shown assets worth 5 crore, so that is complete, we haven't missed any assets. Similarly, with respect to liabilities, clear? See, next, valuation and allocation. Valuation means the value of asset you have shown as 5 crore rupees. So we have correctly valued that asset as 5 crore rupees after reducing the depreciation. So all these assertions you are making to the auditor in the form of balance sheet. Getting it? Yes. Next, similarly, assertions with respect to presentation and disclosure. So, presentation and disclosure can be with respect to both balance sheet items and P&L items. So, the mix of both assertions will be there here. See, occurrence assertion, I have explained you, completeness assertion, classification and understandability, accuracy and valuation. So, these are the assertions with respect to presentation and disclosure. Clear? I guess you understood the concept of assertion. Next, moving to the concept of audit risk. So, this term risk means, see, the term risk you will use to specify something negative, right? So, risk of getting heart attack, risk of, you know, occurring a accident if you drive fastly. So, risk of getting killed if you smoke. So, the term risk you will use to signify something negative, right? Now they are saying audit risk. What is meant by audit risk? See, audit risk, it is basically of two types. First of all, when there are misstatements in the financial statements, then which type of opinion you have to give? You have to give modified opinion. But risk that if there are misstatement in the financial statements, you might give unmodified opinion, is the audit risk. Understanding? So audit risk means nothing but risk of giving inappropriate audit opinion. See, risk of expressing inappropriate audit opinion, and this inappropriate audit opinion can be of two types. First one is, as I told you, you will if there are misstatements, see, when financial statements are materially misstated, you have to give modified opinion, but you are giving unmodified opinion, so you have given inappropriate opinion, wrong opinion. This is one type. Second type is, see, if financial statements, see, express an opinion that financial statements are materially misstated when they are not. That means in the financial statements, actually there are no misstatements. But you are saying that, see, if there are no misstatements, which type of opinion you have to give? Unmodified, clean opinion you have to give. But you are giving a modified opinion. This is also giving a wrong opinion, correct or not? So this is the second type of inappropriate opinion. Now you remember that only first type of inappropriate opinion will be called as audit risk. Second type of inappropriate audit opinion will not be called as audit risk, because here in the financial statements, actually there are no misstatements. So if there are no misstatements, that's fine. But by mistake you gave modified opinion. In this situation, what will happen? You will have to perform some more audit procedures to prove that actually there are no misstatements, correct or not? This is very insignificant, and this will affect efficiency of the audit. Why efficiency will be affected? Because you have to spend more resources to prove that actually there are no misstatements in the financial statements. Understanding? See, I'll explain you in depth because this is very much basic. So, inappropriate audit opinion, you can give it in two ways. So, if there are misstatements in the financial statements, then actually you have to give modified opinion, correct? But instead of giving modified opinion, you have given unmodified opinion, correct? So this will affect effectiveness of audit. Why it is affecting effectiveness of audit? Because you are not able to achieve your goal. If you are not able to achieve your goal, you are not effective, correct or not? So what is your goal? If at all there are misstatements, you have to identify them and give a modified opinion. But in this situation there are misstatements, but instead of giving modified opinion, you are giving unmodified opinion. That means you haven't achieved your goal, so you are not effective. This will affect the effectiveness, correct or not? Which is more serious, correct or not? This is more serious. This should never happen. Second situation, there are no misstatements in the financial statements. If there are no misstatements in the financial statements, which type of opinion you have to give? Unmodified opinion you have to give, correct or not? But instead of giving unmodified opinion, you have given modified opinion. So in this situation, if you give modified opinion, will management be silent? Management will say, see auditor, there are no misstatements in the financial statements, because actually there are no misstatements. Management know that. So management will ask you again, do the audit properly and verify. So what auditor has to do here? Here he has to again do the audit, spend more time, spend more resources to do the audit to prove that yes, there are no misstatements. So this is affecting efficiency of the audit, correct or not? So this is insignificant. This can be rectified once you perform more work. Since this is insignificant, this will not be treated as a audit risk. Okay, so this entire second scenario is not audit risk. Only this first scenario is the audit risk. Getting it? Yes. So that's what this will say. So this will affect effectiveness. First scenario will affect effectiveness, second scenario will affect efficiency, and this second scenario is not considered as audit risk because this is insignificant. Only first scenario will be considered as audit risk. Next, audit risk, it can occur because of error or fraud. What is the difference between error and fraud? Error means unintentional mistake, fraud means intentional misstatement, right? Yes, that is the concept of audit risk. Now moving to risk of material misstatement, Romum. Let us see. So first of all, what is meant by misstatement? In the first introduction chapter itself, I told you what is meant by misstatement, right? If there is a difference between ACPD that is required by the applicable financial reporting framework and ACPD that is followed by the management for preparation of financial statements, then you will call such a situation as misstatement. I have explained this concept in the revision of first chapter, right? You can go to the first chapter and check this. I have explained this, right? The same thing will be the definition. The definition, it will not change, right? Yes. Next, components of audit risk. This is also the important concept. So this audit risk is there na. Audit risk is combination of inherent risk. I will tell you with the example. So you know cash. So if there is a cash, then cash is having inherent risk of theft. Cash is subjected to theft. There is an inherent risk by birth. The quality of cash is such that everyone wanted to steal the cash, correct or not? So this is a inherent risk. So audit risk is combination of inherent risk. So let's say for example, see, inherent risk means risk that is present by birth is known as inherent risk. Now let's say inherent risk of cash being subjected to theft is 50%. So there is a 50% chance that cash will be subjected to theft. Now, knowing that the cash or any item will be subjected to theft, that is knowing the risk, will you be silent? No, you will try to reduce that risk, correct or not? For reducing that risk, what you will do? You will implement internal controls, correct or not? Now, if you implement the internal controls, is it 100% guarantee that internal controls will detect all the misstatements? If you have internal control, is it 100% guarantee that the item will not be subjected to theft? No, right? Internal controls have inherent weaknesses. So internal controls cannot reduce the inherent risk completely. They can reduce the inherent risk to some extent, correct or not? So in the area of cash, you have kept CC cameras as internal control, but CC cameras were able to detect only 75% of risk. Remaining 25% still it is as it is there. So the risk that internal controls will not be able to detect, prevent, correct misstatements is known as control risk. So the second component of audit risk is control risk. Now, in our example, how much is the control risk percentage? 25%, right? Of the total inherent risk, 75% is reduced. Still balance 25%, controls also were not able to reduce. So, inherent risk multiplied by 25%. So, how much you will get? 50% multiplied by 25%. I guess it is 12.5%. So, 50% inherent risk is reduced to 12.5% with the help of controls, correct or not? Yes. So controls reduced 50% of the inherent risk to 12.5%. Now you will call this as this 12.5% as risk of material misstatement, nothing but Romum. Got it? So this is how you will calculate the Romum. So Romum is combination of inherent risk and control risk. Now this inherent risk and control risk, these are not in the hands of auditor. Auditor cannot see, by the time auditor came to the audit, these risks are present already. Correct? Now auditor has to reduce this risk of material misstatement in order to maintain his audit risk to lower level. So this audit risk is there na. While starting the audit, auditor would have kept acceptable level of audit risk. That means if audit risk is this much, it is okay, I will be happy. Like that auditor will fix a acceptable level of audit risk. Let's say for example, in this example, auditor has fixed acceptable level of audit risk as 2%. That means auditor can accept maximum of 2% audit risk. Getting it? That means now the task of auditor is to reduce this 12.5% of risk of material misstatement to just 2%. How you will reduce it? By performing audit procedures. You will perform audit procedures and identify the misstatements and ask the management to correct the misstatements. So this way you will reduce 12.5% risk of material misstatement till 2%. Getting it? Now your audit procedures also cannot detect complete misstatements. Correct or not? So the risk that audit procedures cannot detect complete misstatements is known as detection risk. Getting it? So final component is detection risk. Now this detection risk is in the hands of auditor because audit procedures are performed by auditor only. So detection risk, he will keep it in such a way that okay, the total audit risk reduces to 2%. Now tell me how much should be the detection risk? 12.5% multiplied by detection risk, it should get reduced to 2%. That means detection risk is equal to 2% by 12.5%. That means how much you will get? You will get it 1.6%. So detection risk should be 1.6%. That means 98.4% of the risk of material misstatement should be identified by performing procedures. Just to balance 1.6% detection risk he can accept. So if detection risk is 1.6%, his overall audit risk becomes 2%. Getting it? Yes sir. I'm just cross verifying it whether it tallies or not. You also once cross verify. Yes, it is getting. So this is the concept of audit risk. So see, components of audit risk. I guess now you got a clarity of what is audit risk and the components. It is inherent risk, control risk, detection risk. So inherent risk means susceptibility of an assertion to misstatement that could be material either individually or when aggregated with other misstatements before consideration of any related controls. That means if there are no controls, the chance that the item can be subjected to misstatement is known as inherent risk, which is present by birth. Next, control risk. Control risk means risk that misstatements will not be detected, corrected on timely basis by the entity's internal control is known as control risk. Now, combination of inherent risk and control risk is the risk of material misstatement, correct or not? Yes. Next, finally, detection risk. So, risk that procedures performed by auditor to reduce audit risk to an acceptably low level will not detect the misstatements is known as detection risk. So, these are the components of audit risk. And you need to assess the risk of material misstatement at two levels. First of all, at the assertion level. At the assertion level means we have seen the assertions. You will take the fixed asset and you will check what is the risk that the amount of fixed asset might be wrong. What is the risk that the fixed asset might not be in existence? What is the risk that the entity doesn't have right over the fixed asset? Like this, assertion wise you have to calculate the risk. Similarly, you should also calculate the risk at the entire financial statement level. Got it? Yes. Next, steps in identifying and assessing the risk of material misstatements. Basically, there are four steps in identifying and assessing the risk, which are very simple. First of all, you will identify the risk through understanding the entity. Once you have identified the risk, you will assess that risk, whether that risk is material, whether that risk will impact many items. Like this, you will assess it, right? Assess the identified risk. Once you have assessed the risk, you will relate the identified risk to what can go wrong at the assertion level, which is a third step. And finally, you will consider likelihood of that risk turning into the actual misstatement. These are the four steps that you will perform in risk assessment. So these four steps will be performed by whom? By auditor. Auditor will perform these steps for risk assessment. Next, audit procedures. See, this concept of audit procedures we will see in SA 330 also. In this chapter only, in the coming chart we will see. So, while seeing 330, we will discuss these audit procedures. Again, why? But however, yes, we need to discuss audit procedures here only because there is risk assessment procedure. Risk assessment procedure is covered in 315 only. Okay, we'll discuss it here only. That's the reason why I gave it here. Okay, we can't skip it now. So, audit procedures. Audit procedure means, see, the procedures that the auditor perform: external confirmation, vouching, inspection, all these are some of the examples for audit procedures, correct or not? Now, these audit procedures are of two types, broadly two types. You can further classify them. Firstly, risk assessment procedure. I told you this concept just now as per SA 315. So, risk assessment procedures, the procedures that you will perform for identifying and assessing the risk are known as risk assessment procedures. So, basically, the risk assessment procedures that you will perform are inquiry, analytical procedures, and inspection and observation. These are the three risk assessment procedures that you will perform. We will see those three risk assessment procedures. Next, further audit procedures. So, by performing risk assessment procedures, you have identified the risk. Once you identify the risk, you will provide your response by designing further audit procedures. These further audit procedures, they are again of two types. Firstly, test of controls. Test of controls means the procedures that you will perform to verify whether controls are operating effectively or not is known as a test of controls. And next one is substantive procedures. Substantive procedures means detailed procedures. See, these substantive procedures you can again further classify them into two. First one is test of details. Test of details means, best example for test of details is vouching and verification. These test of details, they can again further be classified into two. Test of balances, nothing but vouching, which is verification of balance sheet items. Next, test of transaction, nothing but verification, understanding. So, test of details can further be classified into test of balances and test of transactions. And substantive analytical procedures. What are these analytical procedures? See, in SA 520, we will see what are these analytical procedures. As of now, you have to remember a important point, that is analytical procedure you can use as both further audit procedure as well as risk assessment procedure. If I told you, if you remember, I told you risk assessment procedures are three. What are those? I told you, firstly inquiry, next one is analytical procedure, right, and the final one is observation and inspection. So if you see analytical procedure repeated two times here, analytical procedure is risk assessment procedure, and analytical procedure can also be used as a further audit procedure. In SA 520, I will tell you how you can use analytical procedure as both risk assessment procedure as well as the further audit procedure. Getting it? Yes. And one important point you need to remember, that understanding the entity is a continuous and dynamic process. See, under this SA 315, your entire job is to identify the risk. For identifying risk, what you will do? You will perform risk assessment procedures. One of the risk assessment procedure is, main one is understanding the entity. Okay, so you will understand the entity. By understanding the entity, you will get to know what risks are there in that entity, correct or not. So understanding the entity is a continuous process which you will perform for identifying the risks that are there in the entity. Getting it? So apart from understanding the entity, you will also perform, see, the following risk assessment procedures. So perform to obtain understanding of entity and its environment. These will include three procedures. I told you these procedures. First one is inquiry. Now, what is meant by inquiry, sir? Inquiry means asking questions and getting answers to those questions. To whom you will ask questions? You will ask questions to management. You will ask questions to those charged with governance. You will ask questions to employees. You will ask questions to creditors. So, to whomever people you wanted, who are related to the management, who are related to the entity, you can ask questions, you can discuss with them, and you will get answers. So through that answers, you will identify the risks that are there in this particular entity. So inquiry is the first risk assessment procedure. Next, analytical procedure. So what is this analytical procedure? Tell me, should I tell you here or should I tell you in SA 520? Okay, since here we are discussing SA 315, I will tell you how you can use analytical procedure as a risk assessment procedure. How you can use analytical procedure as further audit procedure, I will tell in SA 520. Okay, yes. Now, analytical procedure. Analytical procedure means you are analyzing. What you can analyze? You can analyze profit trend, correct or not. So in the past 5 years, the profit of the entity is increasing at a rate of 5%, but in the current year profit has increased at 30% or 50%. Now will you get a doubt or not? Will there be a risk or not? Yes, because in the past 5 years the trend is a 5% increase, but current year suddenly 50% it increased. So you have identified a risk by analyzing the situation, correct or not. This is the analytical procedure performed as risk assessment procedure. Understanding? Yes. Now only I will tell you how to use analytical procedure as substantive procedure so that it will be clear. So let's say, for example, you wanted to verify salaries expenditure that is shown in the profit and loss statement. Generally, how you will verify? You will take the salary vouchers, you will take the bank statement, you will take the entries that are shown, all those things you will take and you will match, you will vouch. This is regular procedure. Another option available is you can use analytical procedure. How? You can ask the management, give me list of complete employees. Let's say they are having 10 employees. You will ask the management, on an average, how much salary you are paying to them. Management might say, we are paying on an average 15,000 per month. For some employees it might be 10,000, for some employees it might be 20 or 25,000, but if you average it, it gets to 15,000 per employee. Okay, per month. So multiplied by 12 months, how much you will get? 15,000 into 10 into 12, so 18 lakhs, right? Now 18 lakhs should be the salary expenditure that should be shown in the P&L as per your analysis. Now if let's say in the P&L exactly 18 lakhs only shown, then fine, you got audit evidence about salary expenditure without detailedly verifying it, correct or not? If let's say salary expenditure that is shown in the P&L is 19 lakh, which is different from the analysis that you made, then what you will do? You will identify the reasons why 19 lakh is coming in the P&L, but for me it is 18 lakh. There might be a possibility that some employees have worked only for 10 months. Understanding, if they have worked only for 10 months, then what will happen? They will not be at the end of year. Management might not have included them in this 10 number. So for them also, the management has paid salary that will be included in the P&L. So this difference might be because of that. Like that you will analyze, getting it? So this is how you will use analytical procedure as further audit procedure. Clear? Yes. Next one is observation and inspection. Simple observation means, let's say the entity's employees are performing physical verification of inventory. You will stand and you will observe whether they are properly counting or not. That is nothing but observation. Inspection means you yourself will inspect the boxes of the inventory, whether actually goods are present in that boxes or not. That is known as inspection. So observation and inspection, through observation and inspection also you can identify the risk. Understanding? So these are the three risk assessment procedures that you can use. Next, so now, risk assessment procedures you will perform for obtaining understanding of the entity. So, what are some of the examples of items of which you will obtain understanding? Let's see. Obtain understanding of the following items. So, relevant industry in which entity is obtained. See, I told you that for identifying the risk, you have to obtain understanding of the entity. How will you understand the entity? By understanding the following factors, you will get a understanding of complete entity. So you should understand, you should know in which industry entity is operating. Is it banking industry? Is it automobile industry? Is it hospital industry? Is it some manufacturing industry? Like that you need to understand the nature of industry, regulatory and other external factors, including the applicable financial reporting framework, whether accounting standards is applicable or Indian accounting standards is applicable. So all these forms part of understanding the entity. Next, you should also understand nature of entity. Is it a company? Is it a partnership? Is it a individual? Is it a cooperative society? So what is the nature of entity? Next, entity selection and application of accounting policies. How entity is selecting and applying accounting policies, that also you need to understand. Next, entities objectives and strategies and those related business risks. So entities objectives means what are the goals of entity? To achieve those goals, what strategies entity is using and what business risks it might face in achieving that particular goals or the objectives. So you need to understand this aspect also. Clear? Yes. Next, measurement and review of entities financial performance. So you should also measure and review financial performance, means P&L statement. Got it? So by understanding these things, you will be able to understand the entity, complete entity. Next, significant risk. What is meant by significant risk, sir? Significant means some important risk which you need to focus more on, correct? So significant risk is having two characteristics. If these two characteristics are there, you will call it as significant risks. Let us see what are those two characteristics. First of all, higher magnitude of potential misstatement. Higher magnitude means if that misstatement occurs, its impact will be very huge. It will affect a lot of amount, that is known as magnitude. Magnitude means impact. You might be seeing in the televisions, if the earthquake occurs, they'll say the magnitude of earthquake is huge. That means impact earthquake has created is huge. Understanding like that. If the magnitude of the risk is huge and there is higher likelihood of occurrence, that means the chance of that risk occurring is very high. So the chance of risk occurring is high, and if that risk occurs, the magnitude it creates is also very high. If these two characteristics are there for any risk, you will call it as a significant risk. Clear? Yes. So, significant risk means risk that require special audit considerations. So, while identifying whether the risk is a significant risk or it is not a significant risk, you have to consider certain factors. What are those factors? We will see. So, see, this significant risk is important. Significant risk is having two characteristics, and in order to identify whether the risk is significant or not, you need to see the following factors also. So first of all, whether it is a risk of fraud. If it is a risk of fraud, then there is a high chance that it might become significant risk. Correct or not? Next, whether risk is related to recent significant economic accounting or other developments. Okay, the risk that has, if the risk is related to the recent economic developments, let's say for example, entity has, not entity, the company, sorry, the government has issued new accounting standard. Now this is a new accounting standard and entity has to comply it. Since it is the first time entity is complying, while complying with that accounting standard, entity might wrongly interpret it and entity might wrongly calculate the values. So this, there is a risk of misstatement here. This risk is because of new changes in law or regulation. So this risk can become a significant risk. Correct or not? Yes. Next, complexity of transactions. So if the transactions are highly complex, then the risk that is there in that transaction can also be a significant risk. See, it is not that if these factors are there, for sure it is a significant risk. No, you have to verify. Okay, you have to consider these factors are there. Will it be a significant risk? You have to consider. Understanding? Yes. Next, whether risk involves significant transactions with related parties. So does the risk involves any significant transactions with related parties? So if the transaction is with related party and there is a risk in that transaction, then that can become a significant risk. This is also one of the factor. Next, degree of subjectivity in measurement of the financial information. Subjectivity means the measurement of a particular item is based on your emotions. Then if at all there is a risk in that measurement, that risk can become significant risk, because you are not making that estimation based on facts and figures. Instead you are making that estimation based on your emotions only. Clear? Next, transactions that are outside the normal course of business. Normal course of business means entity, let's say, is dealing in the sale of cars. So, selling the cars and purchasing the cars is a normal course of business. Let's say suddenly entity has sold a land which is not in the normal course of business. Entity's business is not to sell the land. So, if at all there is any risk in that particular transaction of selling the land, then that might become a significant risk, because that transaction is not in the normal course of business and there is a risk in that transaction, then that risk can become significant risk. Getting it? So, these factors you need to consider in determining whether the risk can be a significant risk or not. Clear? Yeah. Now, standard has told that, see auditor, these risks. First of all, risk of fraud and transaction with related party which is outside the normal course of business, both together. Okay, a transaction which is outside the normal course of business has taken place with the related party. So these two, first one and this one, will always be treated as a significant risk. Clear? See, always treated as a significant risk. What are they? Risk of fraud and transactions with related parties that are outside the normal course of business. These two risks will be always treated as significant risk. So this second transaction is combination of this one and this one. Clear? Yes, sir. I guess by this we have completed essay 315. No, not yet completed. Still there is discussion of internal controls. Now, what is meant by internal control? The simple example for internal control, CC cameras is a simple example for internal control. There is a technical definition also for internal control. Let us see the meaning of internal control. See, it is very easy to remember and understand this meaning. Let me tell you. So internal control means it is a process, correct or not? Internal control is a process which is designed, implemented and maintained. Who will design, implement and maintain the internal control? Whose responsibility it is? By those charged with governance or the management and other personnel, right? And the purpose is, why, what is the purpose of internal control? To provide reasonable assurance about the achievement of entities objectives with regard to following four things. What are the four things? Achieving reliability of financial reporting. That means in the financial statements there are no misstatements, to achieve that reliability. Next, effectiveness and efficiency of operations, safeguarding of assets, compliance with applicable laws and regulations. That means to comply with the requirements of laws and regulations, to keep the assets safely, and to achieve utmost efficiency and effectiveness in the operations. I told you what is meant by effectiveness and efficiency. I told you now, while explaining it, we will be using this term effectiveness and efficiency lot of times, right? Yes. So to achieve these four objectives, the process that will be maintained, implemented, designed by management to those charge governance in the organization is known as internal control. Clear? Yes, sir. Now, I will ask you a question. Think. Is auditor having any responsibility to provide opinion on internal controls? Answer is no. Auditor is not having any responsibility to provide opinion on the internal controls, because if you see SA 200, the objective of auditor, it doesn't speak a single word about the internal control. What does the objective says? To obtain reasonable assurance about whether the financial statements as a whole are free from material misstatements, whether due to fraud or error, thereby enabling the auditor to obtain thereby enabling the auditor to express an opinion on whether financial statements in all material respects are prepared in accordance with applicable financial reporting framework, and to report thereon. This is the objective. Now, in this objective, did you find internal control anywhere? No, right? So auditor is not having any responsibility to report on the internal controls. Then why auditor is verifying the internal controls? See, by verifying the internal controls, the duty, the job of auditor becomes easy. How? I guess I told you this. So let's say sales transaction. Before verifying the sales transactions, auditor will not directly perform audit procedures on sales. What will he do? He will first of all verify internal controls that are operating around the sales. By verifying the internal controls that are operating around the sales, if auditor feels that these internal controls are operating effectively, then the audit procedures that the auditor can perform on sales will be less. Correct or not? If auditor finds that internal controls around sales are not operating effectively, then audit procedures that the auditor has to perform on sales will be more correct or not. So to help the auditor to decide how much audit procedures he has to perform, he will first of all verify the internal controls. So to make his job easy, he is verifying the internal controls. Correct? Yes. Now you can ask me a doubt, sir. Then why SA 265 is asking the auditor to communicate deficiencies in the internal control to management and those charged with governance? SA 265 is that only, communicating deficiencies in internal control with management and those charged with governance. If you see, SA 265, communicating deficiencies in internal control and those charged with internal control to those charged with governance and management. Why 265 is asking the auditor to communicate deficiencies in internal control? See, SA 265 says that, see, auditor, however you are verifying internal controls, I have not put any responsibility on you to verify internal controls, but to make your job, however you are verifying internal controls, right? So during such verification, in case you find any deficiencies, you just bring them to the notice of management. Okay, only those deficiencies you find, you bring. I am not asking you to bring all the deficiencies. I am also not asking you to verify all the internal controls. I am not putting any responsibility, but however you are verifying for making your work easy, so if in case you find any deficiencies, just bring them to the notice of management or those started with governance, so that they will correct, they will improve the internal controls. Correct or not? Yes. But however, there is a exception to this. Internal controls over financial reporting. Internal controls over financial reporting means in the process of preparation of financial statements, some controls will be established. Auditor has to give opinion only on these controls. Apart from these controls, auditor need not give opinion on any other controls. This requirement is also applicable only in the listed companies. Okay, listed companies and some other companies. So apart from that listed companies, in other companies, auditor need not give opinion even on this also. Getting it? Yes. So internal control over financial reporting means controls that are established over the process of preparation of financial statements is known as internal control over financial reporting. This we will be learning in the 6th chapter. Okay, we will be revising this concept next. So what benefits you will get because of understanding the internal control? See, you will be able to identify types of potential misstatements. So if, let's say for example, you identified that internal control in this area is not working properly, then the chance that misstatements will be there in this area will be there, right? So you have identified the potential misstatements that can occur. So internal control is helping you to identify that. Next, identifying factors that affect risk of material misstatements. So what factors will affect Romam? I told you, inherent risk, control risk. These two are these two if you combine, you will get Romam. So by understanding the internal control, you can identify inherent risk and control risk. Clear understanding? Yes. Next, designing the nature, timing, extent of further audit procedure. Of course, based on risk assessment procedures only, your further audit procedures will depend. In the risk assessment procedures, you identified that risk is low, then your further audit procedures will also be less. If you identified that risk is more, then your further audit procedures will also be more detailed, right? So this understanding the internal control will help you to design the nature, timing, extent of further audit procedures. Yes. Next, see, I told you already in the introduction chapter these internal controls, they are having certain inherent limitations. So what are the inherent limitations of internal control? See, internal controls can provide only reasonable assurance that there are no misstatements. It cannot provide absolute assurance. It cannot detect 100% frauds, 100% errors. Next, human judgment in decision making. See, in some situations, internal controls can be manually implemented, like some segregation of duty can be manually implemented. Segregation of duty is an internal control. So you have divided the duty among three people. So in this situation, there is a possibility of human error, human judgment in decision making. So in case of manual internal control, the limitation is human judgment, human decision making is involved. Each person will take the decision in a different manner. Correct. Next, lack of understanding the purpose. So there is a high possibility that internal control can be established or performed without actually understanding why this is established, right? Next, collusion among employees. So collusion, when it can occur in case of segregation of duties, collusion can occur. So you have divided the work to three employees. Now the three employees, they might collude together and do the fraud. Correct or not? So this is also the limitation of internal control, collusion of employees. Next, judgments by management and limitations in case of small entities. See, for the small entities, the resources they will be having is very much limited. With the limited resources, they might not be able to afford to the internal control systems, right? These are the limitations of internal control system. Next, components of internal control. So there are five components to this internal control. So basically, if you see the vehicle you drive, the car you drive, it will be having certain components. This example I used to say even in the regular class also. So for the car to work properly, the wheels, the steering, the engine, right, the brakes, all these components should work properly. Only if all these components work properly, the entire car together will work properly. Correct or not? Yes. Similarly, for the internal control system to work properly, there are five components. If all these five components work properly, only then the internal control system will work properly. Getting it? So what are those five components? Firstly, control environment. Control environment means the environment in the organization should be feasible for the internal control system. So the environment in the organization should be internal control friendly. Clear? So communication and enforcement of integrity. So some of the components of control environment. So in the organization, at most important has to be given to the integrity. All the employees should be communicated that you have to maintain at most integrity. This will improve the environment of the organization. See, environment of the organization depends on how the employees of that organization are getting it. So environment of the organization will be impacted to a large extent by the people of that organization, by the employees of that organization. So you have to enforce at most integrity on the employees. Next, participation by those charged with governance. So the top level people should show much interest for the internal controls to flourish in the organization. And management philosophy and operating style. So management philosophy should be in such a way that they encourage internal controls in the organization. So all these will decide the environment of the organization or not. Control environment. Next, organizational structure. That means who is the top level management, under them who is working, under them who is working, okay, under middle level who is the lower level. That is nothing but a organizational structure. Next, assignment of authority and responsibility. See, you have to assign both authority and responsibility to same person. You should not give authority, power to one person and responsibility to another person. That should not happen. Both should be given to same person, responsibility and the authority. and human resource policies and practices. See, human resource policies and practices will also have a large impact on the control environment. I told you, control environment will be impacted by employees of the organization. So how the employees of organization will be there, like that only the environment of the organization will be there. So while hiring the employees, if you hire correct people, then the environment will be correct or not. So human resource policies are nothing but policies related to hiring the employees, training the employees, and their compensation policy. All these comes under human resource policy and practices. So all these things will impact the control environment of the organization, right? Next, coming to the entities risk assessment process. This is the second component of control environment. See, now we are discussing the components of control environment. First, components of internal control system. So the first component is control environment in the organization. So control environment should be good for the internal control system to work properly. Second one is entities risk assessment process. Sir, we have discussed about auditors risk assessment process, right? See, risk assessment means identifying the risk and taking steps about that risk. So who will identify and assess the risk? As per our discussion, auditor will assess the risk, right, for the purpose of designing his procedures. Here they are saying entities risk assessment. Why? See, not only auditor, even entity will also assess the risk, because in the organization, entity has to establish internal controls. For establishing the internal controls, entity will assess the risk in the organization. Just like there are four steps, if you remember, there are four steps, okay? Steps in identifying and assessing the risk. This is about auditor's risk, I told you here, right? Auditor's risk assessment. Just there are these, just like there are four steps in this auditor's risk assessment process, there are also same steps in the entity's risk assessment process also. So only if entity properly identifies and assess the risk, it will be able to establish proper control activities, correct or not? So entities risk assessment is also one of the component of internal control system which should work properly. So based on entities risk assessment process, entity establishes the actual control activities. Control activity means actual controls that are there in the organization, like policies and procedures related to performance, information processing controls, physical controls means like security guard you are keeping, and segregation of duties. These are some of the control activities. So control activity also should be working properly for the internal control system to work properly, right? So what are the first three components of internal control system? First one is control environment, second one is entities risk assessment process, and the third one is control activities, right? Next one, information system and communication. See, to implement the internal controls in the organization, you should have proper information about each and every item where you want to implement the internal controls, correct? So that information, where from you will get the information? From the information system of the organization you will get the information, right? So information system should be working properly. And also that information, if you just have the information, that is not sufficient. That information should be properly communicated to the relevant people. So information system and communication should also be working properly in the organization for the entire internal control system to work properly. And finally, the final element is monitoring of the controls. So whatever the controls that you have established, that you need to continuously monitor. So in the monitoring, what will you do? You will check whether the internal control that I have designed, is it working properly? Should I update it? Are there any loopholes in the internal controls? Like this you will monitor the internal control. Clear? Yes, these are the five components of a system of internal control. So for the entire internal control system to work properly, all these five components should work properly. Clear? Yes, sir. Next. My next question to you is, are all the controls relevant to the auditor? So during the audit, will you verify all the controls? The answer is of course no. You will not verify all the controls. Only those controls that are relevant for the purpose of audit, that will have impact on the financial statements, only those controls you will verify. Correct or not? See, there is a direct relationship between entities objectives and the controls it implements. See, whatever the controls the organization implements, those controls will be for the purpose of achieving its goals, right? Objectives. So based on what objectives entities want to achieve, that type of controls it will implement. Generally the objectives of entities will be with respect to financial reporting, operations and compliance. Got it? So auditor mostly he will be concerned with financial reporting related controls, and operation controls and compliance controls, if at all they have any impact on the financial reporting process, only then he will be concerned with those controls. Clear? Yes. Next, see, next concept, controls over completeness and accuracy of information. What information? See, for doing the audit, management will give information to you, because you will not have the information. Management has to provide the information. Whether controls over that information will be useful for the auditor, whether auditor is concerned with the controls over that information. See, if auditor uses that information for the purpose of audit, then auditor will be concerned with the controls over that information. If auditor does not uses that information, then auditor is not concerned about the controls over that information. Clear? That is with respect to controls over completeness and accuracy of information. Next, internal control over safeguarding of assets. So the controls around safeguarding of assets, if it is related to administrative aspect, auditor is not concerned with them. If it is related to financial aspect, then auditor is concerned with it. Next, controls relating to objectives that are not relevant to the audit. You only saying objectives that are not relevant to the audit. If it is not relevant to the audit, why will I be concerned with that? Correct? Yes. Next, conclusion. The conclusion that you have to come is, not all controls are relevant to the audit. Only those controls that affect financial reporting are related to the audit. Clear? Yes. Next, for verification of these controls, you want certain information. Correct or not? So to gather that information, certain four methods are available. So to gather information about the internal controls, four methods are available. What are those four methods? Let us see. First one is narrative record. What is meant by narrative record? Do you remember the essay competition in your school? So narrative record means nothing but writing paragraph about the controls that are operating in the organization. So you will observe the controls and you will describe about how the controls are operating. That is a narrative record. So through narrative record you can get information about the internal controls. Next one is checklist. What is meant by checklist? See, checklist will contain some questions that has to be answered by article assistant. Okay, see, members of the auditing staff should answer the questions of checklist. Next, internal control questionnaire. See, internal control questionnaire also contains questions only, but these questions should be answered by management people. See, issued to client, and client is requested to get it filled, getting it. And the questions in checklist will not be that much comprehensive, but questions of internal control questionnaire will be very detailed, very much comprehensive. The basic difference is checklist will be answered by audit staff, internal control questionnaire will be answered by management. Next is flowchart. You can also use flowchart to get information about the internal controls. Example of flowchart, the one that we are learning. Okay, all this is nothing but a flowchart. So flowchart will give you a bird's eye view of entire content. Correct or not? This is the best example of flowchart, right? So if you like these charts that we are using, you comment in the comment section saying excellent audit charts. So if you feel that these charts are useful to you, communicate with me by saying in the comments that yes sir, these charts are excellent charts. Okay, yes. So flowchart. So flowchart is a graphical presentation of each part of the company system of internal control. Now one linking, you can use narrative record for preparing flowchart, correct or not? So by paragraphs that are there, narrative record is nothing but a complete description. You can say narrative record is our audit concise book. In audit concise book we will have the content in the form of paragraphs. Now from that audit concise book I have prepared flowchart. So you can use a narrative record to prepare flowchart. Simple. Wow, what an example sir. Yeah. Next, essay 320. Next, this we left, right? Extent of understanding of the controls. So see, to obtain understanding of the controls, you will understand how those controls are designed and how those controls are implemented, and after implementation, are those controls working effectively, properly? These things you will understand as part of obtaining understanding of the controls. Clear? Yes. Next, starting with essay 3. See, now we have completed complete essay 315. See how much big the essay 315 is. It almost took us 1 hour 15 minutes, right? Yes. So materiality in planning and performing the audit. Materiality. What is this materiality? See, materiality means a important item. Auditor has to determine materiality for each and every audit. Understanding? In fact, auditor will determine materiality at the entire financial statement level, and also for each and every item also he will determine the materiality if he wants. Understanding? This materiality, there is a formula for the materiality. We will see that formula and all those things we will see. So first of all, materiality can be determined at financial statement level and transaction or account balance level. This documentation we'll see, starting with materiality. So in case of audit, we will use the term materiality along with misstatement. Okay, most of the times you will find the word materiality attached to misstatement. Okay, so material misstatement means that misstatement is very important, auditor is concerned with that misstatement. Immaterial misstatement means very small misstatement, auditor will not consider that misstatement for his opinion. Understanding? So you should remember, auditor is always concerned only with material misstatements. He is not concerned with immaterial misstatements. So to determine with which misstatements I have to be concerned, with which misstatements I need not be concerned, first of all I have to identify what is meant by materiality. I have to fix a materiality limit, correct or not? So materiality, how to calculate materiality? There is a formula. Materiality is calculated as benchmark multiplied by a percentage. So benchmark means, I will give some of the examples of benchmark: sales, gross profit, net profit, right? These kind of things you can take as benchmark. So let's say you have taken benchmark as sales. Sales is 2 crore rupees. Okay, 2 crore rupees. And okay, sales is 2 crore rupees, and for this you will apply a percentage. How much percentage you have to apply? That depends on your professional judgment. Generally, percentage that you will use for materiality will be single digit percentage, like let's say some 2%, 3%, like that it will be there. Let's say it is 2%. So 2 crore multiply 2%, how much it will become? 1 crore means 1 lakh. 2% means 2 lakh. So materiality limit auditor has determined is 2 lakh rupees. That means auditor will be concerned only if the misstatement crosses 2 lakh rupees. If misstatement doesn't cross 2 lakh rupees, auditor is not concerned with that particular misstatement. Got it? Yes sir. Now you can ask me a doubt, sir, if at all misstatement is 1,90,000, just 10,000 less than 2 lakh rupees, will you be concerned with this misstatement? See, here comes the concept of performance materiality. What is this performance materiality? See, I already told you, audit cannot detect complete misstatements. By performing audit, you have detected misstatements worth 1,90,000 rupees. There is a possibility that detected misstatement of 1,90,000, if you combine it with undetected misstatements. So, can there be undetected misstatements? Of course, auditor cannot detect complete misstatements. So, there is a possibility that detected misstatement together with undetected misstatement might cross materiality of 2 lakh rupees. Such a possibility is there or not? To reduce that possibility, there is the concept of performance materiality. Now what is this performance materiality? First of all, I will tell you how to calculate performance materiality. Formula for performance materiality is material. See, what is the formula for materiality? You have applied a percentage on the benchmark, that is materiality. For performance materiality, you will apply formula on materiality. Okay, so materiality, let me write correct spelling. Materiality multiplied by a percentage. Now how much percentage you have to take? Again, this depends on your professional judgment. Generally, see, for materiality the percentage will be single digit, 1%, 2%, right? But for performance materiality, the percentage will range. It will be two digits, it will be more, around 75% to 90%. It will vary. Let's say you have taken it as some 70%. Okay, 70% our materiality is 2 lakh, right? So how much you will get performance materiality? 1 lakh 40,000. Yes. So 1 lakh 40,000 is a performance materiality. Now what is the meaning of this performance materiality? That means once the misstatement reaches this performance materiality, auditor becomes alert. Auditor asks the management to uh, correct that misstatement because it has reached the performance materiality. Even though it has not reached the materiality level, there is a chance that the detected misstatement plus undetected misstatement might cross a materiality level. So once the performance materiality is reached, auditor will not take any chance. He will become alert and he will ask the management to correct the misstatement. This is the concept of performance materiality and materiality. Clear? Yes. So materiality. Misstatements are considered to be material if they individually or in aggregate influence the economic decisions of the users. That means if there is a misstatement of 2 rupees in the financial statements, will the users, let's say users or shareholders, okay, shareholders, now shareholders wanted to invest in this company and they got to know that there is a 2 rupees misstatement in this company. Will the decision of the shareholders will get impacted? No, right? Let's say same shareholders got to know that there is a misstatement worth 2 crore rupees. Will this impact the decision of shareholders? Yes, they will not invest in the company. Their economic decision has got impacted, right? So materiality means the level of misstatement that will impact the economic decision making of the users. That is the theoretical definition for misstatement. And the formula based definition we have seen already. Next, it is a matter of professional judgment. Why materiality is a matter of professional judgment? Because the percentage, how much percentage you have to select, you have to apply, right? This is completely based on your judgment. Since percentage is based on judgment, the entire materiality that you derive thereby is also subject to professional judgment understanding. Next, determination of materiality, of course, responsibility of auditor. Materiality is to be applied both in planning and performing the audit, right? Next, while determining the materiality, auditor will take certain assumptions about the users. So, what assumptions auditor will take about the users while determining the materiality? Let us see. So, auditor will assume that users are having reasonable knowledge about the business. Users know about the business, and auditor will also assume that users can understand that financial statements are prepared and audited only to the levels of materiality. That means auditor will not say to the users, we have audited to the level of materiality only. No, he will assume that users already know. Auditor will not audit completely, he will just audit only to the level of materiality. Like that, the auditor will assume. Next, auditor will also assume that recognize the uncertainties inherent in the measurement of amount. So users already know that there is uncertainty involved in measurement of some of the amounts which are related to the future, right? So future, if there is a estimation itself means related to future. Future itself means uncertain, you don't know whether actually the same amount will actually arrive or not, you don't know, right? So users already know this. Like that, auditor will assume. Next, make reasonable economic decisions. So auditor will also assume that users are very intelligent people, they can make their own economic decisions. Like this, auditor will assume. Getting it? Yes. So, materiality formula we have discussed. While selecting the benchmark, I have also told you some of the examples of benchmark, right? So, profit before tax, total revenue, gross profit, all these are the examples of benchmark. Now, while selecting the benchmark, what factors has to be considered? This is very important. Okay, so you need to consider what are the elements of financial statements. So, from the elements of financial statements only, you will select a single element as the benchmark. Correct or not? So what are the elements are there in the financial statements? Sales, purchases, gross profit, net profit, loans, asset. So all the elements you need to consider, okay, for selecting a benchmark. Next, items on which attention of users tend to be focused. So in the financial statements, are there any items on which the attention of the users will be focused? Like in case of banks, users will be more focused on npas, on loans given. So if you are auditing a banking company, you can take benchmark as loans given, because your users are focusing more on loans. Correct or not? So you should also consider this point while selecting the benchmark. Next, nature of entity, you should also consider what is the nature of entity. And ownership structure, so whether it is financed more by debt or more by uh, shareholders fund. So if it is financed more by shareholders fund, shareholders wanted more profits to be generated. Correct or not? Only if profits are there, they will get dividends. So shareholders will focus more on more on profits. So if entity is financed more by the funds of shareholders, auditor can take benchmark as profit. If debtors, that means if by the loan funds, if entity is financed more by the loan funds, then the people who have given loan will focus more on sales, because if more sales are there means more cash inflow will be there. If more cash inflow is there means every time cash will be available with the entity to pay off to the debtor. Correct or not? So that's why they will focus on sales. So in such a situation, auditor will consider benchmark as sales. Next, volatility of benchmark. See, the benchmark that you chooses should not be fluctuating, it should be normal standard. Okay, if there is a high volatility in the benchmark, you should avoid selecting it. Okay, yes. Next, performance materiality. I told you about performance materiality. So, amounts set by the auditor at less than materiality level. See, performance materiality should always be less than materiality, because what is the formula of performance materiality? Materiality multiplied by a percentage. So of course always performance materiality will be less than the materiality level, right? To reduce it to an appropriate low level, the probability that aggregate of uncorrected and undetected misstatements exceeds materiality level. So to reduce the probability of uncorrected misstatements and the detected misstatements both combining together might cross the materiality level, to reduce that possibility you will calculate the performance materiality. Clear? Yes. And of course, as the audit progresses, auditor can and auditor shall revise the materiality. It is not that once you have determined the materiality during the audit at the initial stage, it should be fixed like that only. No, as the audit progresses, you can revise it, you can increase it, or you can reduce it. That is freely available. Okay, that is up to you. Getting it? Yes. This is SA 320. Next, SA 265, right? So it deals with communicating deficiencies in internal control to those charged with governance and management. About this, I told you, auditor is not having any responsibility to verify internal controls. But however, during the audit, to make his work easy, he is verifying internal controls. So during such verification, if at all he finds any misstatements, if at all he finds any deviations, communicate them to management or those charged with governance. Okay, so first of all, what is meant by a deficiency in the internal control? In the two situations, you will call it as deficient. So what are the two situations? First of all, internal control is unable to prevent, correct, detect the misstatements, then you will call it as deficiency. That means deviation in the mistake, deviation in the internal control, you will call it as a deficiency. Or required internal control is not at all present, then also you will call it as deficiency. Getting it? So internal control is not preventing, detecting mistake, not preventing, detecting, correcting misstatements, or internal control required is not at all present. In both the situations you will call it as deficiency, right? So control necessary is not present, is unable to detect, to prevent, correct misstatements. Now once it is a significant deficiency, you have to communicate it with those charged with governance. So what is the communication process? See, communication process determine whether one or more deficiencies are identified. Okay, whether there is one or more deficiency in the internal control, you will identify. Once you have identified some deficiencies, you will see whether that deficiency is significant deficiency, because you will communicate only significant deficiencies with those charged with governance. Understanding? See, whether they constitute significant deficiency, you have to see what will be a significant deficiency, we will see that also. When you will call a deficiency as a significant deficiency, we will see that also. Okay, so you will determine whether they constitute a significant deficiency. Once if it is a significant deficiency you feel, then communicate in writing significant deficiencies to those charged with governance on a timely basis. See, why you are communicating significant deficiencies in internal control with those charged with governance? So that those charged with governance might take steps and improve those internal controls. For that purpose you are communicating significant deficiencies in internal control to those charged with governance. Clear? Yes. Now when you will call a deficiency in the internal control as significant deficiency, see, here you need to apply your professional judgment. Okay, see, deficiency or combination of deficiencies in internal control that in the auditor's professional judgment is of sufficient importance that to merit the attention of those charged with governance. So in the professional judgment of auditor, if he feels that this deficiency has to be brought to the notice of those charged with governance, then it becomes a significant deficiency. Understanding? So to determine whether deficiency is significant or not, you have to apply your PJ, professional judgment. Next, in determining whether deficiency is significant or not, some of the factors are given by the standard. Let us see what are the factors that you have to consider for determining whether a deficiency is a significant deficiency or not. First factor, see, factors to be considered. First factor, likelihood of deficiencies leading to material misstatement. Okay, so this is internal control. There is a deficiency in the internal control. If this deficiency leads to material misstatements, then there is a high possibility that this deficiency can become significant deficiency. Okay, next, susceptibility to loss or fraud. So if this deficiency leads to fraud or error to occur, then also there is a high chance that this deficiency will be treated as significant deficiency. Next, subjectivity and complexity of determining estimated amounts. So, if lot of subjectivity is involved in determining the estimated amounts and the controls around such estimation are not proper, or there is a deficiency in the controls around such estimation, then also you will call such a deficiency as the significant deficiency. Clear? Next, financial statements amounts exposed to deficiency. So if let's say sales is very important, correct or not, because it will be of huge volume. Miscellaneous expenditure is not that much important, correct? So if there is a deficiency in controls around the sale, then that might become a significant deficiency because underlying item is important. On the other hand, if there is a deficiency in controls around miscellaneous item, then that might not be treated as a significant deficiency. Correct? Yes. Next, volume of activity. So if the volume of activity in a particular item is more transactions are occurring and there is a deficiency in the controls around such a transaction, then also such a deficiency can become significant deficiency. See, all these are the factors that you have to consider to determine whether whether the deficiency can become significant or not. It doesn't mean that if these factors are there, that a deficiency is always a significant deficiency. No. Okay, next, interaction of deficiency with other deficiencies. Okay, so individually a deficiency might be insignificant, but this deficiency might interact with other deficiency and both of them combined can become significant, correct or not? So this also you need to consider. Got it? To determine whether the deficiency is significant or not. Next, I told you, once you identify the significant deficiencies, you have to communicate the significant deficiencies to those charged with governance in writing. So, in that written communication, what will be there? See, description of the deficiencies will be there. Description means you have to clearly describe why this will become significant deficiency. Such a clear description has to be given, and you should also give sufficient information to enable those charged with governance and management to understand context and explain the following things. So you should not say that there is a deficiency in so and so area. No, you have to give clear description. You have to give context so that the management and those charged with governance will understand actually where the deficiency is there, why that has become significant deficiency. These things should be properly understood by them. In such a manner you have to describe it clearly. You have to describe it in the written communication. Okay, so you need to explain that purpose of the audit was to express a opinion on financial statements. So in the written communication you need to mention, see, management and those charged with governance, the purpose of our audit was to express opinion on financial statements. Our purpose is not to express opinion on the internal controls, but see, Audit included consideration of internal controls relevant to the audit. However, for the purpose of making our work easy, our audit included consideration of some of the internal controls also, and matters being reported are limited to those deficiencies that the auditor has identified during the audit. So you will say that during the audit I have verified some of the internal controls for the benefit of my audit. So whatever the deficiencies I am communicating, they are limited only to those deficiencies that I have identified. That means there can be some more deficiencies in the internal control which I might not have identified. You should not think that I have identified all the deficiencies and communicating to you. No, these are only the deficiencies that I have identified. There can be some unidentified deficiencies also. Clear? Such a clear communication you need to give to the those charged with governance in the communication. Okay. Next, internal financial controls. Internal financial controls means those controls that are established over the financial aspects to achieve the objectives of same. Reliability of financial reporting, effectiveness and efficiency of operations, compliance with laws and regulations, safeguarding of assets and prevention and detection of frauds and errors. Simple, similar to that of internal control definition, right? Yes. So this is essay 265. Now we will move to essay 330. I told you the link between essay 315 and essay 330. As per essay 315, you have identified the risk. Once you have identified that risk, for that risk, you will design audit procedures as per essay 330. So essay 330 deals with further audit procedures. Essay 330 deals with responses of the auditor to assess the risk of material misstatements as per essay 315. Correct or not? So if you see the name of essay 330, it clearly says auditors responses to what? To assess the risks. Where you have assessed the risk? In essay 315 you have assessed the risk. What is meant by auditors responses? Auditors responses are nothing but auditor procedures. Clear? Audit procedures are the responses that the auditor is giving. See, so this standard deals with auditors responsibilities to design and implement responses to the ROMM. Responses means you should always remember that response of the auditor as per SA 330 is the audit procedure that you will perform. Okay, further audit procedure that you will perform. See, matters to be considered in determining extent of test of controls. So as a part of SA 330, you will perform further audit procedures, right? Further audit procedures also includes this test of control. If you see this chart, we have already seen in SA 315, right? In SA 315 we have already seen this chart. So further audit procedures also include test of controls. Test of controls means those procedures that you perform for the purpose of testing the controls, verification of the controls, right? So what matters you have to consider in determining the extent of test of controls? Let us see. Frequency of performance of the control. So how frequently the control is being performed? Let's say for example, control over sales will be more frequently performed than control over rental expenditure, because rent expenditure there will be one transaction for each and every month, but sales transactions it will be throughout the year. Every day you will have. So controls over sales are working throughout the year, right? They are being performed many times. So if control is being performed more times, you have to check that control very detailedly. Correct? So your extent of testing of control depends on how frequently that performance, how frequently that control is being performed. Got it? Yes. Next, length of time during the audit period auditor is relying on the control. So controls over entire financial reporting process will be relied by the auditor throughout the audit, right? Whereas controls over inventory will be relied by the auditor only while auditing the inventory, right? So controls over inventory auditor is relying for less period, whereas controls over entire financial reporting he is relying for more period. So if he is relying on any control for the more period, he will test that control more. Got it? Yes. Next, expected rate of deviation from the control. Deviation means I told you deviation or deficiency same. So if the control fails to detect, prevent, correct the error as required, then you will call it as deviation. If such a deviation in the control is more, then also you will test that control more, right? Next, relevance and reliability of audit evidence. So if the audit evidence that has to be obtained is more reliable and more relevant for the purpose of auditor, then controls around that obtaining of audit evidence you will test more, because that audit evidence is more important for the purpose of audit. Next, extent to which audit evidence is obtained from test of other controls. Got it? So all these factors will impact the extent of testing of the controls. Next, nature and extent of test of controls. So in determining the nature and extent of test of controls, you will consider other audit procedures in combination with inquiry. So what type of audit procedure you have to perform as a test of control? Nature of test of control means what audit procedure you have to perform for testing the control. Nature of procedure. So the first one you can use is other audit procedure in combination with inquiry. Inquiry means asking questions. You can ask questions to the employees or anyone in the organization about controls, and you can get information. So this is the first procedure that you can perform. Next, determine whether controls to be tested are dependent upon other controls. So if control 1 that you are testing is dependent on control 2, that means only if control 2 works properly, control 1 can work properly. In such a situation, if you are verifying the control 1, of course you should also verify control 2 also, because both of them are interrelated, right? Let's say for example, verification of BRS. Okay, verification verification of BRS, is this a control? Yes. Preparation of BRS, this is also a control. Preparing a BRS is also a control. Now verification of BRS is the BRS means bank reconciliation statement. So verification of BRS is dependent on preparation of BRS. If first control itself is not working properly, how can you do the second control? Correct. So in this situation you have to see whether the control that you are going to test is it dependent on other control. Next, inquiry combined with inspection or reperformance. So you have to prefer doing inquiry, asking questions combined with inspection and reperformance. See, by inquiry you will get what? Information, right? They are saying you perform inquiry along with reperformance. So reperformance means already entity has performed a particular activity, you are again performing it. So by reperforming it, you are checking whether the information that I have obtained through inquiry, is it correct only or not. By reperforming the activity, you are cross verifying it. Another thing that they are saying is inquiry along with inspection. Inspection means you will inspect the documents, you will inspect the inventory, right? Physically verifying them, inspection. So the information that you have obtained through inquiry, you can cross verify it through inspection, correct or not. That's the reason why they are telling you to perform inquiry along with reperformance or inspection. See, you will not perform inquiry alone. Always you will perform inquiry along with other audit procedures like reperformance or inspection. Okay. Next, nature of particular control. So all these factors will impact the nature and extent of test of controls. Got it? We are almost completing this revision. Still one more page left. Okay. Yes. This audit procedures we have already discussed, right? Next, considerations in designing further audit procedures. So, in designing further audit procedures, what considerations you will take into account? See, reasons for the assessment given at Romum. So, as per SA 315, you have identified Romum, correct or not? So, you will consider that Romum for designing further audit procedures. I have explained I have explained this. FAP will be dependent on the results of your RAP, right? Next, likelihood of material misstatement. This also you will consider for designing FAP. FAP means further audit procedures. Next, relevant controls also you will consider. If controls are working properly, then your FAP will be less. If controls are not working properly, then your FAP will be more. FAP means further audit procedures will be more. Next, more persuasive audit evidence, the higher the auditor's assessment risk. So if auditor has assessed that Romum is high, then he will obtain more persuasive audit evidence. Persuasive means believable. Okay, the one on which you can believe more is persuasive. Got it? Yes. Next, timing of test of control. See, it depends whether you can test the controls at a particular point of time or during the period. Got it? Let's say you are verifying controls around inventory. You wanted to obtain evidence about inventory as on 31st March, correct or not? So you will verify controls around inventory at the point, right, at the point of time as on 31st March. Whereas sales will be during the entire period. You wanted to obtain audit evidence about the sales during the entire period, so here you will verify the controls during the period, over a period of time, correct? So it depends based on the item you are verifying, the period of verification of the control around it depends, right? Yes. Next, specific inquiries by auditor when deviations from the controls are detected. So when auditor actually identifies that this control is not working properly, there is a deviation in this control, then what are the specific inquiries that the auditor will ask? Let us see. So test of control provide appropriate basis for reliance on controls. I have performed test of controls. Did my test of controls provide me appropriate basis for arriving at the conclusion? That auditor will consider. Okay, that specific question he will ask himself, because he has identified some deviations, right? So since you have identified some deviations in the control, you will ask yourself, I have performed this test of controls now. Are these test of controls sufficient? Did this test of controls identify all the deviations? Like this you will ask the question yourself. Okay. Next, additional test of controls are necessary. I have performed this test of controls, are these sufficient? Should I perform some more test of controls? This question also you will ask yourself. See, you are inquiring yourself. Next, potential Romum need to be addressed using a substantive procedure. So, if at all there is any potential Romum, potential means as of now it is not there, it will occur in the future. So, to address that Romum in the future, should I perform any substantive procedures? So, these inquiries auditor will make himself if he identifies any deviations in the control. Okay, deviation means I told you already. Next, using audit evidence obtained in previous audits. So, auditor, he would have obtained audit evidences in the previous audit, in the last year audit. Same items he might be auditing in the current year also. So, the question is, can he use the same evidences that he obtained in the previous year audit for the current year audit also, or should he obtain new evidences again? Tell me. It depends on certain factors. Let us see. So effectiveness of other elements of internal control. So if other elements of internal control are working properly, then you can rely on the same audit evidence that you have obtained in the previous year for the current year also, because the controls, they are same as it is, no change of controls has happened, so you can rely on the same evidence. Next, risks arising from characteristics of control. So the characteristic of control is such that it continuously changes, and new risks will arise from that control. Then better to test the control again, better to obtain new evidence again in the current period also, instead of depending on the old audit evidence. Okay. Next, effectiveness of general IT controls. See, about this general IT controls, we will see in a separate chapter. There is a separate chapter which deals with this information technology. There we will understand the general IT controls. Okay. Next, whether lack of change in particular control poses a risk. So you should also consider this. If this control doesn't change frequently, doesn't update frequently, will this result into a risk? If this results into a risk, if the change of control is not made properly, that will result into a risk, then better to test that control again, better to obtain new evidence with respect to that control again, instead of depending on the same previous year's audit evidence, because this control has to be changed continuously. The nature of that control is such that, understanding. Next, romum. If you have identified that romum of the particular area is high, then better to test that area again, better to obtain evidence again, instead of depending on the previous year's audit evidence. Next, establish continuing relevance of that evidence. So all these factors you should consider before deciding whether to rely on the previous year's audit evidence, or should I obtain again a new audit evidence for that item. Clear? Yes. By this we have completed essay 330 also. So we have discussed four standards, right? 315 is done, 265 is done, 330 is done, and another one 320 is also done, right? Now one more standard is left, which is 450, a very small standard and very easy standard. Let us see. So the link I have established. Essay 315, you have identified risk. Essay 330, you have responded to risk and identified the misstatements. Now you will evaluate these misstatements as per essay 450. Let us see. So essay 450, evaluation of misstatements identified during the audit. How will you evaluate the misstatements? So first of all, what is meant by misstatement? I have already told you. If there is a difference between ACPD that is required by applicable financial reporting framework and ACPD that is followed by the management, you will call it as misstatement. I have discussed this in the first chapter, right? First chapter discussion. Next, uncorrected misstatement. Uncorrected misstatement means misstatement which is not corrected. This can be either detected or undetected, right? Yes. Next, factual misstatement means actually it is a misstatement. No one can deny, no one can argue that it is not a misstatement. Such a misstatement is known as factual misstatement. Okay. Next, judgmental misstatements means, see, management, while preparing the financial statements, they will take a lot of judgments, like for providing a provision for doubtful debts, they will exercise a judgment. So now these judgments are subjected to misstatement, correct or not? You are making judgments about future, and the amount that will occur in the future, you cannot predict accurately. So judgments are always subjected to misstatement, nothing but judgmental misstatement. Clear? Next, projected misstatement. What is this projected misstatement? This is related to SA 530. 530 deals with audit sampling. So in case of sampling, what you will do, if the population, total population is 1000, and you are not able to verify complete population, So you have selected sample of 100 items and performed audit procedures on that sample, and you have identified that there is one misstatement in the sample. So now you will project this one misstatement to the entire population. That is, if in 100 items one misstatement is there, means in 1000 items how many misstatements will be there? You will cross multiply 1000 multiplied by 1 divided by 100. How many will be there? 10. Like this you will project the misstatement to the population. This is known as projected misstatement. Getting it? Yes. Next, clearly trivial misstatement. Clearly trivial misstatement means very small misstatement which is insignificant, inconsequential, like rounding of error. Because of rounding, a misstatement of 1 rupee occurred. This is clearly trivial. By just seeing it you can tell that that is inconsequential, immaterial. Got it? That is clearly trivial misstatement. Right. So now we understood the meaning of all the misstatements. Now we'll go into the standard. So consideration of identified misstatements as the audit progresses. So as the audit progresses, how should you deal with these misstatements? Okay. See, misstatements, they can be of types. Misstatements, firstly, detected misstatements and undetected misstatements. Undetected means you haven't identified them yet. Now detected misstatements, they can again further be of two. Once you have identified, detected the misstatement, you can either correct them, corrected and uncorrected, right? And these undetected misstatements, they will always be uncorrected only. They cannot be corrected, because if you have not at all detected the misstatement, how can you correct them? Correct or not? So misstatements, you can classify them like this. Now in this background we will study the remaining concept. See what they are saying. Consideration of identified misstatements. Identified means detected misstatements as the audit progresses. Now identified misstatement indicate that other misstatement might exist. So the identified misstatement gives you a proof that there is a other misstatement exists, or aggregate of misstatements approach materiality. Okay, in such a situation determine whether overall audit strategy and audit plan need to be revised. So you have identified the misstatements and you are feeling that not only these identified misstatements, there can be some more misstatements in the financial statements, and that undetected misstatements and the identified misstatements, both of them together might cross the materiality level. Like this you are feeling. In such a situation you have to determine whether you have to change, alter your overall audit strategy and audit plan. I told you while discussing SA 300, audit strategy and audit plan are subject to change. They can be altered during the audit. This point I told you, correct or not? So in this situation, you have to decide whether you have to alter the audit plan and strategy. Next, evaluating the effect of uncorrected misstatements. So the misstatements which you have identified and uncorrected, misstatements which you have not identified and uncorrected. Understanding? So they are telling about uncorrected misstatements. How will you evaluate the effect of uncorrected misstatements? First of all, you have evaluated about identified misstatements. Now uncorrected misstatements. See, reassess the materiality. Once reassess whether the materiality level that I have fixed, is it okay for this situation, or should I change the materiality level? Should I increase or decrease the materiality level? Next, in determining materiality of uncorrected misstatements, auditor shall consider the following things. See, they are saying you need to clearly observe the terms uncorrected. That's the reason why I have given you this chart. You note down this chart and read this, and go through this concept. Only then you can relate. Okay, so determining materiality of uncorrected means it can be either this or this. Okay, so in determining materiality of uncorrected misstatements, auditor shall consider size and nature of misstatements. So misstatement is uncorrected, management has not corrected it. What is the size of such misstatement? What is the nature of that misstatement? If the size of uncorrected misstatement is small, you can leave it. If the size of uncorrected misstatement is huge, you should consider it in your opinion, right? Next, circumstances of their occurrence. How did they occur? And effect of uncorrected misstatements. What effect uncorrected misstatements will have on the financial statements? So you should consider these 3 points in assessing, in evaluating the effect of uncorrected misstatements. Then you will communicate with those charged with governance. Following things: uncorrected misstatements and their effect. See, those charged with governance, during the audit, I have identified some misstatements and told to management. They have corrected some misstatements and some are uncorrected. These are uncorrected misstatements. These uncorrected misstatements will have this much effect on the financial statements. Like this, you will communicate with those charged with governance. Next, effect of uncorrected misstatements related to prior periods. So in the prior period, in the last year, if you have identified any uncorrected misstatements, what effect that uncorrected misstatements will have, that also you will have to communicate with those charged with governance. Next, request. So by communicating that these are the uncorrected misstatements, finally you have to request those charged with governance. Those charged with governance, please correct these uncorrected misstatements. Got it? Like this, you will communicate with those charged with governance. Next, misstatements identified during the audit. Communicate with management on a timely basis and request them to correct. So, first of all, before going to those charged with governance, the first one to whom you have to go is management, right? Whatever the misstatements you identify, you will tell to management and correct them. If management doesn't correct, then you will take them to those charged with governance, right? Yes. If management refuses, understand reasons and consider while framing the opinion. Got it? Yes. Now, I forgot to tell you the difference between management and those charged with governance. We will also discuss this. See, this standard got completed. Yes, say 265 is completed. I'll just discuss with you difference between management, those charged with governance. So, management is having responsibility with respect to executory functions. Okay, whereas those charged with governance will have responsibility with respect to decision making. They are always involved in a decision making activity. Okay, some of the examples of management: CEO, managing director, whole time director. These are the examples of management who will be involved in day to day operations. Some of the examples of those charged with governance: best example is board of directors, audit committee. Understanding? So, board of directors means there will be managing director in the board of directors. There will also be whole time director in the board of directors. There will be normal directors. There will also be independent directors, right? So, all these people together you will call board of directors. So, this board of directors, all these people together will be those charged with governance, because any decision that has to be taken in the company should be taken together by all these people. Got it? Now, if you see, I have given that managing director will be management, whole time director will be management. If you observe here, managing director is part of board of directors, whole time director is also part of board of directors. So, by this, you should understand that there can be common people, there can be common people between management and those charged with governance. It is not that management and those charged with governance are completely separate. In some companies, some people can be both in management and also those charged with governance. Do you know what? In some companies, both management and those charged with governance will be one and the same. There will not be any differentiation. Understanding? So in some companies, board of directors together will be both management and also those charged with governance, because in that company executory function is being done by board of directors and decision making also being done by board of directors only. So in that company board of directors are both management as well as those charged with governance. Getting it? So in determining management and those charged with governance, you have to see what function they are doing. If they are doing both the functions, they will be both management and those charged with governance. Clear? Yes. So this is discussion of chapter number 4. I guess you understood completely the chapter number 4. If you have any doubts with respect to this chapter, you can ask me in the comment section, okay, or you can message in our telegram group also. I will be replying you your doubts. Got it? And you know what to do. If you feel that this revision class is useful to you, you have to comment saying the best, right? Yes. Now I'll open the chart for fifth chapter. Okay. Yes.